Retail holders have been speaking out for XRP as the sleeping giant of the digital finance industry for many years. However, something truly spectacular is taking place right now. Chat rooms and cryptocurrency forums are giving way to the glass towers of Wall Street as the location of the debate shifted. Digital assets are currently being investigated not as a kind of speculation, but rather as a form of infrastructure by major asset managers, which are the same powerhouses that are reshaping traditional banking. XRP, a coin designed specifically for use in international financial transactions, lies at the heart of this shift. When institutional investors like BlackRock enter the market, the question that has to be answered is not if they will do so. Rather, it is how they will do so and what will happen to price discovery when they do. The introduction of the first Bitcoin exchange-traded fund, ETF, by BlackRock not only made it possible for mainstream investors to participate in Bitcoin, but it also legitimized digital assets for the largest pools of wealth in the world. A single ticker symbol has the potential to instantly expose trillions of dollars worth of assets, including pension funds, sovereign wealth, and insurance portfolios. There was a significant lesson that Wall Street learned from that triumph. In the same way that clarity comes after regulation, liquidity comes after regulation. In light of the fact that more frameworks are taking shape, the next natural step is to diversify beyond Bitcoin. Analysts are already wondering what will happen after the period of Bitcoin exchange-traded funds, ETFs, and XRP with its operational utility in the real world and its institutional-grade settlement technology is at the top of that speculative shortlist. A distinction can be made between XRP and the speculative assets that came before it. Instead of being intended to take the role of fiat currency, it is intended to connect it. Financial organizations transport trillions of dollars across international borders every second, using networks that are both slow and expensive. The ledger of XRP is capable of settling the identical payments in a matter of seconds, almost completely free of charge, and making use of energy efficiency that is suitable for the ESG-driven investing landscape of today. This mix of speed, affordability, and compliance potential is, in all honesty, appealing to Wall Street. As a result of this, analysts identify XRP as more than just a cryptocurrency. They consider it to be an infrastructural asset. Despite the fact that the idea of an exchange-traded fund ETF for XRP may sound futuristic, the logic behind it is actually quite simple. If institutions are able to store and hedge Bitcoin and Ethereum through regulated vehicles, then there is really no fundamental reason why they couldn't later construct products around other digital assets that are consistent with regulations. Custody has always been the missing component in the situation. For the purpose of providing safe and regulatory-approved storage for tokenized assets, companies such as Fidelity, BNY Mellon, and Coinbase Institutional are competing with one another. It will be possible for the machinery of Wall Street, including fund products, derivatives, and loan markets, to begin operating nearly immediately after the institutional custody of XRP has been properly standardized. Within the framework of such future development, the function of XRP will move from retail speculation to liquidity provisioning. You can think of it as a plumbing system for money itself. It is still necessary for every exchange-traded fund, ETF, tokenized bond, and on-chain fund to have a medium to settle value. In the event that XRP is able to secure even a minority portion of that market, the numbers will become spectacular. The annual value of global cross-border settlements is greater than $150 trillion, 0 cents. The demand for on-ledger securities would increase by hundreds of billions of dollars if only 1% of that flow was captured as transactional liquidity. Obtaining a valuation model that is a topic of discussion in boardrooms is the result of applying that mathematical calculation to a fixed supply of 100 billion tokens. It is for this reason that a great number of observers identify the year 2025 as the year when institutional money will finally start to comprehend what early advocates of XRP have been stating for a decade, namely that utility and not speculation is what defines long-term value. It is not the wise money that follows the hoopla. It comes after the volume of settlements and the cash flow. As the world continues to tokenize assets and payments, there will be an increased demand for bridges that are efficient. Already designed specifically for that use, XRP is already in use. According to BlackRock's own research teams, tokenization is the future of all financial assets. This is something that has been openly stated. There have been other occasions where Larry Fink has discussed the digital transformation of markets, in which blockchain technology serves as the foundation for everything from equities to real estate as well. The infrastructure that he is describing sounds extremely similar to what the XRP ledger already provides, despite the fact that he has never approved a single commodity. Compliance, compatibility, interoperability, and speed are all important. If and when global asset managers start building diversified token portfolios, it is only logical that bridge assets such as XRP will be evaluated, modeled, and possibly incorporated into the portfolios. From that point on, the story begins to reinforce itself throughout. The liquidity of the market increases, the volatility decreases, and the number of institutional participants snowballs once significant funds devote even a modest percentage of their assets to settlement layer tokens. These businesses already have access to the clarity they want thanks to regulatory frameworks such as Europe's MiCA and the United Kingdom's post-Brexit crypto policy. It is highly possible that the United States will replicate this practice, thereby enabling registered goods to hold digital infrastructure assets in accordance with stringent disclosure regulations. The knock-on consequences are something to consider. XRP exposure can be held by pension managers, endowments, and sovereign wealth funds through the use of a transparent regulated exchange-traded fund, ETF, or trust structure. This helps them to avoid dealing with uncontrolled exchanges. Just that one modification opens up trillions of dollars in fresh demand. The benefit of the network is increased with each new layer of participation, which might range from custodian banks to hedge funds. You are aware that the market begins to value XRP not because of speculative excitement, but rather because of transaction throughput, liquidity depth, and interoperability measures. This is analogous to the way that traditional commodities are valued based on supply-demand dynamics. At that point in time, the concept of valuations in the 4 or 5-figure range is not a fiction. In other words, it is a mathematical representation of increased consumption. In point of fact, the overall global payments market is far larger than the value of the entire cryptocurrency business at the present time. Assets that enable settlement flows to travel on-chain will have their prices adjusted to reflect the relevance they have to the system when the settlement flows migrate. The adoption rate and liquidity cycles will determine whether that number is 100, 1,000, or $10,000 per token.